Your house is a liability. The only way to turn your house into an asset is to utilize the equity to put that into motion for your house to actually pay you money.
Infinite banking, of course, is used in specially designed whole life policies to capitalize your money, to store your money, and also replace the banking functions in your life.
How do we use these vehicles? As a tool. Money is a tool. How do you use it? A HELOC is a tool. How do you use it?
Hey, what's up, everyone? Welcome to Wealth Webinar Wednesday. Today's April 2nd, 2025. My name's Stephen Nagy. I'll be co-hosting the show today on behalf of Chris Naugle, who is on an airplane right now headed out to San Diego, California for a big mastermind event going on out there. He's also going to be doing a networking event tonight, just a little pop-up event. So if you're in the San Diego area, he'll be at the Legacy Center, downtown San Diego, I believe. I can get you more information on that. But around 6 o'clock, 7 o'clock this evening, they're just going to have a little meetup right there in the lobby and get some people together and have a fun little time. So Dexter, I know, is over in the chat box. I believe he'll be in the area, so Mission Valley area. So we'll see you guys there. But today we got a really good show for you. We're going to be talking about the infinite banking concept. We're going to talk a little bit about what it means to us as money mentors, how we've applied in our lives, and how Brian and Joe have really taken the concept a step further. They've really leveled up in how they're using infinite banking to move their money by taking advantage of the equity in their homes, rolling that through and moving that into investment projects and to grow wealth, and kind of how all that comes together. I believe that's what we're getting into, right, Joe, today?
That sounds like a good game plan.
Yep.
Awesome. Well, with that being said, again, my name's Stephen Nagy. So I've been partners with Chris since 2019. We've really built BYOB, the Private Money Club, together, and have been doing some really fun things together now for several years. So I help Chris with a lot of these different webinars and really manage the business, our clients, our customers, our members, our relationships, and have an awesome time. A lot of you guys I've seen at live events. We've met in person, we've hung out, and those of you that have been around the campfire, you know what I'm talking about. Those of you that are new here today, I'll also drop some links over the chat as we go so you can join us for more and more. We just wrapped up March Money Madness, which was a really cool 4-week series in March that we did on this Wealth Webinar series. So if you're new here, Wealth Webinar is a webinar we do every single Wednesday at 1 p.m. Eastern with different financial education and investment topics every week. Usually we take this recording and on Saturday we edit it up and put it on the YouTube channel so you can go back and watch those recordings. However, for March Money Madness, for the first time ever, we did not put the recordings out to the public. We put it into an exclusive BYOB Money School membership package called MSTV, which is Money School TV. We just relaunched it earlier this year. So we took our March Money Madness series, stuck that into MSTV. So if you're in MSTV, you can go watch those recordings if you missed any of them, or if you want to join MSTV, get your checkbooks out, get your credit cards ready. It's a whopping $197 for the entire year. We do weekly live content every single week, exclusive for MSTV members. We put new content on all the time. We have tools in there and all kinds of bonuses and benefits to you for $19 a month or $197 for the year. So we can drop the link for that if you want to take advantage of that. But with that being said, I just want to do a quick introduction. So Joe and Brian, I'll let you guys introduce yourselves, your backgrounds, what you do with Money School, and then we'll dive into this here today. I'm looking forward to it.
Yeah, I'm Brian Fouts, everybody. One of the many mentors here at the Money Multiplier and BYOB, located in North Idaho. Anybody cares? I'm way up in the mountains. Fortunately, I have internet. Snow is finally starting to melt. But I've been doing infinite banking for, gosh, I've known about it for about 13 years. I've had my first policy was over 10 years ago. Not a very good policy. It was a learning experience as we all go through that journey. But today I've been teaching people, man, since 2016, I think I've been actually talking about it, helping people do infinite banking, educating people, and and using it in my own life, and actually getting ready to do some pretty cool things with a new policy here in the next few months, which is kind of what we're going to be talking about. Joe and I on this call is about those strategies. So I'll get into that here in a bit, but I'll leave it up to Joe to continue introductions.
Well, I'm Joe Kovacevic. Some people call me HELOC Joe. Started with Chris back in 2018 as one of his private money lenders, and then started IBC in 2019, became part of the team in 2020. I've been in real estate since 2000, been utilizing velocity banking and HELOC since 2010, private money lender since 2013, retired from my day-to-day job in 2016 at 42 years old, and been utilizing IBC, velocity banking, HELOCs, leverage to lend and climb the ladder and travel around with Stephen and Brian and Chris all over the country, talking to people at masterminds in regards to how to help you climb to the next ladder.
Yep. Awesome.
Yeah. And Joe, I know you have you were a huge skeptic before you dived into infinite banking and I love that story. I mean, do you mind just kind of sharing it, just even an abbreviated version, kind of what got you into it?
I'll do the quick one. So, Chris says, "Hey, what do you think about life insurance?" And I'm like, "Yeah, I don't know about that." And so it took me 16 months, and I was around the campfire. I was going to meetings twice a month. I was listening to Brent flying in, doing presentations, but I never had that aha moment. My mindset was still stuck in, I was a flipper and I was flipping houses and I was utilizing the money. So I went to the Cadillac dealer. My wife wanted to buy a car. Well, that ended up in me purchasing 3 cars that day. And I had to go to the bank, get a cashier's check. So when I took that cashier's check, I stopped the uninterrupted compounding interest from that bank. So when I was at the dealership and I handed the check over to the salesman, that's when I had my aha moment. And I was like, I just lost this money forever. I should have paid myself first. And then I could have utilized the money, still had the cars, and still had my money growing for me. So that was my aha moment.
Yeah, and from that moment of retiring from the railroad, doing some real estate investing, and then really learning about how to move that money and get it in infinite banking. I mean, just to give you guys a quick little preview of what we're going to be getting into today, Joe went from that to being the hugest skeptic ever for 16 months to finally being like, okay, let's get one of these started. I mean, to now he just sent me this of what he's doing now today using infinite banking along with everything else. I mean, if you just take a glance at that right there, that's pretty wild, right? So
Wow.
Joe, we're gonna dig into this though, right? We're gonna explain to everyone what this is, right?
Absolutely. Yeah, we can dig into that later.
All right, cool, man. So we're gonna have some fun with that, but it's super impressive to see, what you've been able to accomplish and the businesses you've started. You have a whole team now that works with you with infinite banking, helping
Yep.
clients get started and making sure they fully understand it and get there a moment. So I love how you kind of taken it just from your skepticism to building a huge business and heading towards a huge empire, for lack of a better word. And congratulations on that. And then Brian, something with you that I think is really, really pretty cool when it comes to all this is you are really on the marketing side of things a lot more, kind of just promoting IBC, but you were never on the agent side. So you knew
Yeah.
IBC, you knew how it worked, you knew all the benefits, advantages, you help people kind of understand the beginning part, but just in the last year and a half or so, you've really dove into the back end to understand the mechanics and how to actually build the policies and what's right for clients. I mean, so I guess, just real quick on that, like what's your biggest aha from that moment of kind of going from one side to the next or anything you learned along the way with that?
Oh gosh, yeah. So when I first got my first policy, it was set up by somebody, I think this was 2012, something like that. Been a while. And this person talked about infinite banking. I'm like, oh, that sounds really cool. I think I've heard about that. A lot of us have heard about it. And I got a policy. Then fast forward, I ended up acquiring a business that was a financial education business. And I worked with Robert Kiyosaki's personal advisor. So they were my content creators. So I would go fly down to their offices, shoot some content with them, and I learned from them. Well, one of them was an infinite banking practitioner, and he ended up being my mentor. And it was like, that was my aha moment. When he started talking infinite banking, I realized what he's talking about and what I have are not the same thing at all. I had what is called a DUL. By the way, I still have it. It's complete garbage. And I realized, oh my gosh, there's people over here talking about infinite banking that are literally using it to, I don't want to say sell people on something that doesn't really, they're not giving you, but that's what happened to me. They sold me on the concept, but they didn't give me that actual tool. So my big aha moment was, oh my gosh, there's people out there doing the right thing, but there's this whole other group doing the bad things for people and not helping people. And I realized that was my experience. And so that sort of set me out on this mission to really start talking about infinite banking, helping people understand it, because I realized how powerful it was because of that mentor. So having access to the right people that have the right knowledge, that know how to set it up, that was my big experience. I was like, man, there's a lot of people getting sold the opposite of that. So I started teaching people on it. I grew that business to an Inc. 5000 business in 2020 during COVID, helped a lot of people do it. But then I realized in my journey, I kept coming back to infinite banking. I would do this business, do e-commerce, do other things, but it always came back to infinite banking. And I realized I love it, I like it, and I love helping people use it. So I decided to make a switch and just focus on this mainly for my main focus. So yeah.
Yeah, it's awesome stuff. And, we're going to dive into, a little higher level today when it comes to infinite banking. We're not going to go through the basics, what we call our 90-minute presentation. So just so everybody's aware, I'll share the link to that over here, but we don't have anything to sell today, but everyone has our permission to kind of be direct with you, right? Everybody's okay with that. And we are going to talk about why this makes sense, why you should do this. And the way that we get compensated, just so everybody's very perfectly clear, is we are all licensed insurance agents to be able to just sell life insurance. And so if you decide to start a policy, if it makes sense for you financially and makes sense for your situation, your goals, your problems, whatever we're solving, if that makes sense and you start a policy, we get compensated directly from the insurance carrier. So nothing comes out of pocket, nothing's different. If you were to call an insurance carrier direct or have us start a policy for you, it's the exact same policy. That's how we get compensated. Now, we do earn quite a significant less amount of commission compared to a typical life insurance agent, typically anywhere from 60 to 90% less commission per policy. And the reason for that is because when we design these policies, these life insurance policies for you, we design them for banking purposes, which means getting you access to the cash value immediately within 30 days. A typical whole life insurance policy, you start that thing, you might have some cash value benefits down the road in 7, 8, 9, 10, 12, 15 years from now. What we do is we give up a lot of our commissions and we design these in a way where you can start taking advantage of it immediately within 30 days. And what I mean by that is the money that you put into the premium, what we call the deposits into your new banking system, those premiums you're able to borrow against. But every dollar you put into those premiums now sits in that policy, compounding uninterrupted, tax-free growth guaranteed for the rest of your life, even while you're simultaneously taking that money out. And it's what we call the and asset. So it's not, hey, let me, put my money in this whole life policy or go buy the cars. Like in Joe's example, he realized he could put the money in the policy and go buy the cars. But instead of giving the money to the dealership and that cash is gone forever, now that money's in his policy, compounding, guaranteed, tax-free for the rest of his life, building a legacy for his daughter, and he gets to go buy those cars. And whether you're buying cars, whether you're paying off debt, whether you're investing in growing wealth, buying real estate, whatever the case is, that money's out in that policy for the rest of your life, compounding and growing. So we're going to, get into some higher level stuff on how to use these policies today, but I'll put the link to watch the 90-minute video, but be sure to schedule a call. We don't have anything to sell. Like I said, we get compensated, but Joe and Brian are here today to introduce themselves, to connect with you guys. So they'll put their calendar links over in the chat box, and you guys do that now if you don't mind, just so people that need to hop off early in case they want to schedule with you. But they'll do a 60-minute video call with you, and they'll talk through what are your goals, what are your problems? Do you have debt? What are you looking to accomplish? What does that look like? And we'll talk through with you exactly what that plan looks like. And we also have what we call our BYOB vault, which are a handful of tools that can mathematically prove everything that we show you. So during the process of opening this banking system, we'll be able to show you with data and numbers exactly what that looks like as well. So that's all part of that strategy call. So again, this doesn't cost you anything out of pocket at any point to us. It's just part of the service. And then we do also provide ongoing lifetime service to all of our clients as well. So anytime you have questions, need to meet with us, need to make changes to the policy, policy, something arises in your life, something unexpected, we're right there for you. And again, none of that costs anything. And of course, as all of you know that are on right now, we do 6 different live webinars free every single week. And we put out content on the YouTube channel just to support, educate, because Brian and Joe, I mean, I'm sure you guys would agree with me here, but infinite banking is not something you learn once and forget about it. Starting a whole life policy for becoming your own bank isn't something you buy once and forget about. It's something you're going to actively use for the rest of your life. So to me, anytime I'm going to actively use the rest of my life, I want to constantly be learning about that. What's new? What's changing? What's going on? What are new strategies? And so that's what we do, is we constantly are using our own policies to go out there and try new things and find new opportunities. And then once we find out that that works and it's a good thing, then we bring it to the campfire, our BYOB campfire, which you guys are now all part of. So we, recommend and invite you to join us regularly on these webinars. And anytime you have questions, we do have an Ask Me Anything webinar we do every Wednesday at 4:30 p.m. Eastern that you can join as well, ask questions, and our whole Money Mentor team is on there. The last thing I'll say, that Joseph and Brian are both Nelson Nash certified practitioners, and we do follow what Nelson Nash teachings as well, which we think are very, very important. So with that being said, guys, where do you kind of want to start with this? I know last time you two were together, it got into a really good conversation. So I don't want to get in the way of that too much. I can talk for, you guys know I can talk for hours, but where do you guys want to start with this? I'll let you kind of.
Awesome.
Yeah, I'll talk into it, but I want to answer one question. Someone said, what is a VUL? It's variable universal life insurance policy. And why is it garbage? Well, let's just say it's been almost 15 years and the cash value in the policy is not even 50% of what I put into the policy. And the premiums are going to skyrocket eventually, and eventually it'll all go to zero. It'll implode itself. So if you know what I just said, you understand. If you don't, just understand that it's going to actually lapse, and all the money I put into it will be gone. The death benefit will be gone, and it'll not exist. It is a horrible policy. And an acquaintance, I won't call him a friend, built it for me. High commission policy. But anyways, I can get into that for quite a while. But as far as kind of this call here goes, the way I kind of look at this is that when it comes to wealth, how is wealth destroyed? And it's destroyed a few different ways. One is taxes, right? Taxes destroy wealth. Interest and debt, those things destroy wealth because we're being programmed throughout our lives to use it a certain way that benefits somebody else. Not us in most cases, but somebody else. As an example, a mortgage. When you get a mortgage, whose asset is that? It's not yours, it's the bank's asset. What is it to you? It's a liability, right? And so a mortgage, in my opinion, and I know, Joe, we've talked about this, is probably one of the worst financial instruments that exists. And if you understand what I just said, you might be like, no, why? Why is it bad? Well, did it exist before the 1950s? Not really. It didn't exist. Why did the mortgage come to exist in the first place? Well, home ownership wasn't a big deal before baby boomers, after the war, right? So they came back, and guess what they needed? They needed housing. Okay, so what did the banks say? Well, let's offer them, something that's going to benefit us, and let's come up with this random amortized mortgage that, guess what? We're going to sell it as a low premium or low payment, so low interest and a low payment. But in reality, that's not what it is. So if you understand how those work, the first, 7 years is 80% interest. So if you have a 3% mortgage and the first 7 years is 80% interest, that doesn't really seem like a very good deal. But why is it 7 years? Well, they knew the average family moves every 7 years. So they're making all their money up front. Why 30 years? Why is it a 30-year mortgage? Average working time until retirement is 30 years. So they'd sell it as you own your home outright at 30 years. And so we've been sold this, okay? But what Joe and what he's going to be talking about here today is how do you use that same asset? It's not really an asset, but how do you use your home to create an asset or be an asset to build wealth and do the opposite of what you've been taught to do with money? So that's kind of what we're going to be diving into today. And also how to use that thing to accelerate and reduce the other thing that's stealing your wealth, which is debt. And I'm going to be doing this strategy, by the way, here in the next few months. I'm going to document it. I'm going to do it a bit differently than what Joe's going to be talking about because of my situation, which I'll explain here in a moment. But so, Joe, anything you want to add to that?
No, you said it. Amortization, I call it devil's arithmetic, because that's the only way. That's the only way the banks can come up with something, in that kind of a mindset. Amortization and simple interest are two entirely different things. Like you brought up 3%. Well, 3% amortized over that 30 years is equivalent to about 12, 13% of simple interest. So and I handhold people and I go to the bank and sit down with them, and the people at the bank actually say to the client, you do know that this is 8% and the HELOC is 8% and your mortgage is 5%. And I says, absolutely. Why would we want to be paying somewhere upwards of 16 when we can cut it in half to 8? Even the people at the bank don't know the difference between simple interest and amortization.
It gives you an idea of how programmed they are. They've been programmed to sell a certain thing because they've been programmed that it's a good deal. In reality, it's not the vehicle per se that is the thing, it's how you utilize it. That's what's important. And that comes with knowledge, right? So everybody's heard me talk about this. What do we want to control in life? Money and time are the big ones, right? But your mindset or your knowledge is the third one that most people skip over. If you don't have the right mindset, you can't even do what we're talking about. So Joe, kind of, if you can, so I know we have some new people on this call here. What is a HELOC?
Hey, before you get there real fast, Joe, and we'll get there. One thing I wanted to mention, and I think this is fascinating from what you just said, Brian, I just thought of it. So, you say how bankers, they're programmed to think one way. I mean, if you think about the path to becoming a banker, typically that's just a job. Like somebody graduates with a finance degree or whatever degree, and they're just like, okay, what am I going to be? And, banks offer good security and salary. I know they don't make much money, but it's comfortable for some people, especially when they have, not a lot of other options or they don't really know what they're trying to do. And so you go and you become a banker, and the bank's obviously going to tell you what benefits the bank. So they're going to teach you and program you, as you say, to sell what benefits them. It's the same thing as a financial advisor. I mean, when I was hired by Ameriprise Financial to be a personal financial advisor, I had no experience. I didn't know what I was doing. I went out and passed my tests. I had a Series 7, a Series 66, a Florida 215 variable annuity license, and I started to go towards my certifications as a planner. But at the end of the day, I didn't know anything about that. I didn't have any experience. I just got out of school and didn't know what I wanted to be. So I joined Ameriprise Financial. And what did they teach me? They taught me how to sell their products, sell their funds, sell their things that they made money off of. And that's what I did. I spent 65 hours a week cold calling people, trying to sell people Ameriprise's products. And I had no idea about any of it. What makes what we do so special, in my opinion, is that all of us got here and are sitting here on this webinar today by choice. We all had other careers. We all had lots of other options. We decided to implement something called the infinite banking concept in our own lives, found the power of it and how it helped our families, and then decided to use that experience to share with other people. So it's almost like the backwards of what a lot of these banks and financial institutions do when they're giving financial advice to other people. We're doing the same thing, giving financial advice to a point, but at that same point, all we're doing is sharing our experiences, sharing what worked with other clients the infinite banking, using whole life this way has been done for over 200 years. So I just think that's a big difference and makes a big difference who you're going to listen to. I mean, would you rather listen to the kid just out of college that's just being told to say and do what the companies tell them to say and do so they can make a bunch of money? Or would you rather have people are telling you because it truly is what helps people? And that's exactly what this is all about. So the other thing I wanted to make a mention of, you guys hit on that I think is very important, is not only is there a huge difference in simple interest and amortized interest, but also compounding interest. So compounding interest is really the backbone, the foundation of how the infinite banking concept works. So simple interest would, just a quick example real fast. So simple interest, $100,000 loan at 12% is, divided by 12 months is $1,000 a month. So 12% of the 100,000 is $12,000 a year, $1,000 a month. So you pay that, that's simple interest. Amortized $100,000 loan, about 93% 97% of that interest, that like 8% of that payment you're paying back in the first year goes all towards interest. So you're almost paying back zero of the principal in that case. Now, compounding interest, that's where it gets fun. That's where like that old saying, would you rather have $1 million given you today or a penny given to you today that doubles and compounds every day for the next month? You know, and then take that money at the end of the month. Well, at the end of the month, you have something like 3.4 or $7.2 million, depending on how many days are in that month. So if you took the million up front, you don't understand compounding interest. And that's the power of these policies. You put that money in up front, and then for the rest of your life, that money sits in there uninterrupted compounding, even while you're simultaneously using it. So just keep those different terms separate too. Simple, compounding, and amortized as we start getting into this HELOC discussion. So Joe, what is a HELOC?
A HELOC, a home equity line of credit. That means that you can go in on Monday, deposit $10,000, on Tuesday, take out $5,000, on Wednesday, deposit $1,000. It's a line of credit in and out. The banks sometimes, most of the time, will try to change that into a HELOC loan that is on a schedule. They might offer a little bit less of an interest rate, because 9 out of 10 times HELOCs are adjustable. But that's another thing that we'll get into later with the simple interest and the difference between paying 4% or paying 8%. When it's simple interest, it's like pennies. When it's amortized, it's like thousands of dollars. Totally different creatures. But a line of credit is available, just like a savings account. So when people come to me and they say, yeah, I have a HELOC and I'm utilizing it as a second lien, but they still have their mortgage. First question I ask, do you have a savings account? Yes. Why? Well, how much money is in that savings account and how much do you owe to that HELOC? Well, I'm making 0.01% in that savings account and I'm paying 8% in the HELOC. My question is that HELOC not just as available to you as the savings account? And they say, no, it is. And I said, so why are you segregating your money? Why do you keep your money in a savings account when you are paying interest on that money when you have it? So 9 out of 10 times by the end of the call, I save that person, you know, $100, $200, $300, $400 a month just in interest by changing their mindset. And that's all it is. How do we use these vehicles? As a tool. Money is a tool. How do you use it? A HELOC is a tool. How do you use it? I use mine for leverage. I use it because it's giving me equity out of my home, and I use that money as leverage and put that into something, into an opportunity that makes me more interest than what I'm paying to the bank. Therefore, that's spread. So I just make money, other people's money.
Yep. And there's some good questions coming in here. So when we say HELOC, it's home equity line of credit. So HE and then LOC. So take away the HE, it's just a line of credit. So real quick for some people that may be new to this, what is a line of credit? A line of credit is just it's money that it's an account or, you know, a line of credit that you can borrow against and pay back and forth, back and forth. A mortgage, if you put more into a mortgage, you don't get anything back out of it, right? So with a revolving line of credit, which is what a line of credit is, you can put money in, take money back out, back and forth. So a HELOC is just unlocking the equity in your home, because the only way to access equity in a home is to sell it or get something like a HELOC where you can, and the HELOC is what the banks don't want to do. They want to lock you in for that higher interest stuff. So what you're doing with the HELOC is unlocking that line of credit through your equity in your home. So to answer someone's question over here, HELOC, like let's say you don't have a home, okay? You can get a personal line of credit, okay? That personal line of credit is going to be based upon your financials, maybe some collateral, something like that, but it's a line of credit, okay? So same thing. So you can go and get a personal line of credit as well. Now, what's the other asset that we use, Joe, that is also a line of credit, a revolving line of credit?
The IBC policy.
Exactly. So a cash value life insurance policy, specially designed or correctly designed, is also a line of credit or revolving line of credit. So yes, we're talking about HELOCs because it is the most common one that we use for velocity banking as an example. But just keep in mind, a line of credit can be used for what we're going to be talking about here, I'm going to be using my banking policy as my line of credit here in the next few months. So because that's the asset that I have. Frank asked a great question. What are your thoughts on HEI?
I don't even know what that is.
Trying to think of what was he thinking? HEI, home equity loan. That's not a line of credit. A home equity loan is just a loan.
Hey guys, it's Craig just chiming in from the background.
Yeah.
That is similar to what Quantum does, where you're doing an equity share, where they'll give you a line of credit, but then they do a share in your equity at some point. So that's different than the home equity line of credit, but it's another strategy.
Yeah, a HELOC, home equity loan agreement, typically they're called, and it takes well, at least with Quantum RE, and they're not available in all states. We've worked with them in the past, Matthew Sullivan over there, but they basically it takes the equity in the home and they give you all that money now today up front, and you're not required to pay it back until either you want to or you sell the home. So basically they're putting a value on the home for a future, in the future, and it's get paid back, with interest and or with their split in it later on. So it wasn't a bad strategy, especially when home prices were going up hugely and the market was really raising. Right now, I know it's not quite as beneficial. And we also, we're talking a lot about that before these first lien HELOCs have really become more mainstream and usable. From talking to people with the first lien one bucket system, in the past, it's been very difficult. Joe, I know with the guys you work with, they've really streamlined that, automated a lot of it. That does a lot of like the nightly, and you can tell the technical, I'm not the expert at this, but the nightly, money movement, a lot of that's done for you now and things like that. So are we going to get into those details, or where are we going with this?
We can, absolutely. One thing
so
I wanted to touch with Brian said is your house is a liability. The only way to turn your house into an asset is to utilize the equity to put that into motion for your house to actually pay you money. That is the only way to turn your house into an asset. Until that day that your house is paying you to live in it, it's a liability.
Yeah,
absolutely.
And you just want to differentiate real fast, like velocity banking versus what we're talking about, right?
That's what I was going to explain, because we're going to get into how we're talking about HELOCs and line of credits. We're going to talk about here in a moment how to use that thing to accomplish certain goals. Right now, we're kind of laying the foundation of what is a HELOC, what is a line of credit, because there's a lot of confusion about those and how do I get them. So a couple of questions here, first versus second lien position HELOCs, we're going to talk about those, but yeah, you can have a first position or second. They're the same, they're not the same thing, but they operate the same way. One, it just is behind a mortgage. One is actually replaces the mortgage, or you're purchasing a home with a HELOC. So someone said here, can you purchase a home with a HELOC? Yes, you can. You can. You have to have the right bank. You have to have the right knowledge to do that. That's why Joe's here. And that's his expertise. But yes, you can do that. And then someone here they're actually selling their home because they got into a mortgage. They got talked out of a HELOC. And I've heard that horror story many, many times. It's unfortunate when it happens. And then Charlotte, if you're going in to get a HELOC and they keep calling it a loan, go talk to somebody else.
Yeah.
Don't keep talking to them, because either they don't know or they're trying to sell you something that's not to your benefit. Now, velocity banking versus infinite banking. So yes, they are two separate concepts. Infinite banking, of course, is usually specially designed whole life policies to capitalize your money, to store your money, and also replace the banking functions in your life. Okay. In velocity banking, I'll let Joe kind of explain that one.
So velocity banking, the interest that's charged is the average daily balance over the 30 days of the month. So if you're utilizing your HELOC correctly and trying to perform velocity banking, let's say you get your bills together in one part, either at the beginning or at the end of the month. And let's say the HELOC payment comes out on the 25th, your credit cards come out on the 26th, and you pay the rest of your bills, your utilities or whatever, the 28th. So on the calendar, 7/14/21/28, your paycheck comes in, direct deposit into your account. So on the 7th, your money comes in. What happens to the principal? It went down. On the 14th, your paycheck comes in. Your principal went down. On the 21st, your principal went down. So that's 21 days of a decreasing principal balance. Now, 3 days later, you pay the HELOC, you pay your bills, so it only increased on 3 days. The average daily balance is how the bank gives you the number for the interest that you have to pay. So therefore, it's going to be less on average because you're utilizing velocity to get a lesser payment over the month.
Yep.
And
Yes.
we have a couple of questions coming in. So I'm going to hit some of these as we go because they're relevant
Yeah.
to the topic we're talking about. And just to clarify one more time. So your mortgage, when you have a mortgage on a property, it's in what's called a first lien position. And all that simply means is that if you were to default on those payments, the mortgage holder has the first right to take that property back as the collateral to recoup their money from that loan. And then from there, a traditional HELOC is in what's called a second lien position. So you have your mortgage in a first lien position. Let's say it's a $300,000 home and you owe $200,000. So $200,000 of that $300,000 that your home is worth is in a first lien mortgage. And that means you have $100,000 of equity in your home. With a traditional HELOC, you can tap into that equity. Let's just say you can get 100%. So you have a $100,000 HELOC. That HELOC is in a second lien position, meaning the mortgage remains in first position, and then you have a HELOC in a second position. That HELOC is used completely separately and independently of your mortgage. So your mortgage payment, none of that ever changes. You're just using the HELOC over here completely separately as a line of credit, meaning when you borrow money, you're charged interest, you are required to make monthly payments back to it. If you're not using the line of credit, you're not paying anything. It's completely independent. Now, what we're going to get into here with what everybody's saying over in the comments is what's called a first lien HELOC. Or what are some other words for it, Joe?
All in one.
All in one.
All in one. So what happens there is you do replace your mortgage with this all-in-one product, this first lien HELOC that not only gives you the equity in their home, but also creates a new mortgage for you, essentially. Is that right, Joe?
It turns the entire value into simple interest.
Okay. And
Instead of amortization. It would be a first position, correct?
It turns into a simple interest. Okay. And then a cash out equity refi. People talk about that too. And all that means is if you have the $300,000 home, you owe $200,000. What they're going to do is they're going to give you a new loan, a new mortgage for $300,000, and that $100,000 in equity, they'll just give you in cash. Essentially, that's what it is. But the problem with that though is your new mortgage is now $300,000. It's going to adjust your rate back up. It's going to start that 30-year amortization schedule over again. A lot of fees are typically involved in things like that. So if you're 5, 7, 10 years into that, let's say 7 to 10 years into that mortgage, well, you've already paid off a lot of interest, even though all that's gone towards interest and nothing towards principal in those first 7 to 10 years. So when you do a cash out equity refi, you're basically just restarting that clock and starting back over where all your payments are now going towards interest again and very little going towards principal, where you could have actually started paying down principal. So we're typically against and don't recommend or don't ourselves do cash out refis for that reason. You agree with that, you guys? Or anything you want to add to that?
You start over the clock and you pay another payment to the bank. Give them another paycheck.
Yeah.
Now, that being said, though, I did one time, but I did it to get out of an ARM. So that's an adjustable rate mortgage, which are very dangerous. So I got into a house using that, and within 12 months, I refied it back out again to get into a fixed. This is 20 years ago now. But yeah, so that is a time where you might want to refinance, because I had a very risky mortgage and I'm glad I got out of it, because it would have imploded.
Yeah, no, that's a good point. I mean, and a lot of what we talk about, we're going to talk about what works, for what most people are doing or what usually goes on. Of course, there's always little circumstances you gotta, that could make a difference, especially when it comes to investment properties and those kinds of loans. If you are 5 years into your mortgage, is a HELOC still worth it?
Absolutely.
Absolutely, but it has to make sense to you first as well. That's why my one caveat says, yes, it does to us, but it has to make sense to you. So you have to have that knowledge first as to why you're going to use it, why you're going to replace it with a HELOC. But that's why we're all here right now. That's why we're talking. It's because we're getting that knowledge.
Yep, we'll get into that. Just a couple more questions and we'll move on to the next piece of this. So Tim said, I'm trying to get a first lien HELOC and can pay down the interest to 5.3% for 3,500, or it'll be 8.3%. What are your thoughts on this? Their rate on their HELOC would be 8.3, but they can pay 3,500 bucks to lower it to 5.3.
It depends on the math.
Yeah, it depends on how large the HELOC is, what the amount is you have available to borrow against. If you're rolling anything into the HELOC, I mean, there's a lot of factors that would have to be considered.
Yeah.
So we need a spreadsheet person for that.
Yeah. We can run all those numbers, Tim. Definitely schedule a strategy call. We can dive more into that personal situation for you. Can you get a HELOC on an investment property?
You can.
Yeah, certain banks. I mean, keep in mind that certain banks, they all operate differently. So you got to have the right bank. And obviously you can reach out to us. And I think Joe has some recommendations on that one, right?
Yeah. I'm starting to find them now.
Yeah. Can you get an HELOC through an LLC?
No, because you have to be the owner of the property. It has to be your primary residence for a HELOC.
Yeah. And then David had a question. A credit score of 659, would be able to get a good enough rate to get a HELOC? So that is the one thing about a HELOC is you have to qualify. So I do have clients that are doing velocity banking, which is what we're going to roll into, but they're not doing it on a HELOC because they can't get one. I'm actually one of those examples. I cannot get a HELOC. I can't get a mortgage because I haven't. Another reason. So I've been very fortunate not to have paid federal income tax for the last 5 years. But banks don't like that because if you show zero revenue, but you're fine, they don't like it. So I'm actually changing that this year. But so we have people that are doing infinite banking, which is exactly what I'm doing here next month, I think, to do velocity banking. So there's more than one way to do it.
Yep.
Awesome. All right, let's keep rolling.
You ever feel like you don't have control of your real estate business or your money? That's right. The big banks and the institutions, they're in control, right? I know you felt that before. Private Money Club puts you back in the driver's seat. As members often tell us, it's a total game changer. Join the community of like-minded lenders and borrowers by going to privatemoneyclub.com and sign up.
Okay, so I guess one of the questions here, and we'll come back to some of these, but I want to make sure we kind of get into how can you use this asset, a HELOC, to then one thing first, reduce debt, pay off debt, recapture debt, and then once you've done that, then flip it over to the wealth building side. Okay, so Joe, I know you have an example of how velocity banking works and how you can move your debt into the policy or sorry, into the HELOC, but one of the main things people do with the HELOC is they wipe out debt, because debt, by the way, is just taking money away, give it to somebody else. So get rid of that debt as fast as possible so that now you can then turn that around and put that money to work for you. So
the best way to invest is in yourself by getting rid of the debt, getting rid of the third party, and then putting yourself in control. So I talk about the 4 pillars when I talk to clients on the phone. First is you have to pay yourself first. Second is you need to be in control. Third one is money not in motion does not make money. And the fourth is spend interest, never principal. So when we utilize the HELOC, we'll do a first position lien, get them out of the mortgage. That's putting them in control. Now we pay off the debt, do the debt consolidation. Now that's living inside the HELOC. Now we'll take the leftover, run that through a policy, put that into an opportunity. That opportunity comes in with interest. Now you're going to be spending the interest and not the principal because you put the principal to work.
Exactly. So Joe, do you want to bring up that image and kind of walk through it?
Go ahead, Stephen, can you pull that up? Absolutely. So this is my one pot system. So utilizing the HELOC is the nucleus of the system. It's your savings account, your checking account, and your investment account. Every penny that comes into the house gets deployed into the HELOC. And then when you utilize the paying the bills on a monthly basis, like I said, if you can kind of get them together instead of all staggered through the month, that's how the velocity is incurred, because now you're only increasing the balance maybe 3 or 4 days out of a 30-day span. So the other 27, 28 days the interest keeps on decreasing, therefore saving you interest to the bank. So then after we figure out the HELOC, and if we're going to do a first lien or a second lien, are we going to debt consolidate? How are we going to do it? And what problems are we solving? Now we're going to pay ourselves first by utilizing a policy. So now all the money we can run through the policy. And then we can take the money out, run that through the investment. The investment will give us interest. That interest will come right back into the HELOC. Your W-2, your paycheck goes into the HELOC. If we have any rental income, that goes into the HELOC. Everything is a one-pot system. So that's the money going in, going through, running it through the policy, running it into an opportunity or an investment, and then the money comes back around into the HELOC.
And so one of the things I know that people get kind of stuck on, Joe, is why would I want a 10% HELOC? They get stuck on the interest. So explain that again. You already did it once where you talk about how we reduce the principal balance, bring it back up and reduce it. Kind of explain that to people, because what people don't understand is that when you have a mortgage, you cannot play with the interest rate. It is what it is. It's structured. The only thing you can do is pay down the principal faster so that your overall volume of interest is less. With the HELOC, because you're actually paying yourself first, you can manipulate, if you want to call it that, the interest rate that you're actually going to incur.
Right, a little bit because of the utilization of the velocity that's going into it. Now, if you're going to take a HELOC and you're going to put a new roof on your house, that's not utilizing the tool correctly. You would get a HELOC, and if you needed to put a roof on your house, you would take the HELOC, you would put that into an investment. So if you're paying 8% on a HELOC, you're going to find an investment for 12, 15%. Now you're making arbitrage. You're making spread your money on your principal. So you take the principal, you put that to work, you make interest. So now with that interest that comes in per month, 500, 1,000, whatever, now you can utilize that to fix the roof or pay off the credit cards or utilize, however, whatever problem we're solving next. But this is where pillar 4 comes in, that you just want to utilize the interest, never the principal. So when the paycheck comes in for the W-2, the principal balance goes down. Once we acquire another $25, $50, $100,000 in the HELOC, well, we have to implement that and we have to put that to work. So that would be pillar 3, money not in motion does not make money. The more money that we have into investments and opportunities, the higher our cash flow is. In regards to the interest rate and cash flow, so between 4% and 13%, if we put this on the magic calculator and we say, okay, well, you have $500,000 house and this is how much money is coming in per month and this is how much money is going out, at 8%, it might take you 5 years to be debt free. So then we change that number to 13% because usually they're adjustable rate mortgages. Well, that 5 years might go up to maybe 6 years or maybe 5.5 years. And if we drop it down to 4, it does the same way going backwards. It'll drop it to 4 years or 4.5 years. But if we were to add that extra $1,000 or $2,000 a month in cash flow, that 5 years drops down to 2.5, 2.75 years. Cash flow is king when it comes to utilizing the system, not necessarily worrying if it's going to be a 5% or 6%. That gets negated because of the system, because of the money and the cash flow coming in, and because of the velocity and the money always in motion is staying in motion. So that kind of negates the numbers.
So it's math. And so, I mean, obviously, yeah, there are spreadsheets and things out there that can map it out. But so
well, Joe, let's talk about that. So if somebody had $25,000 in a bank account and that bank account was giving them 4% interest, and they wanted to buy a vehicle for $25,000, and the car dealership said, hey, we'll give you a 6% loan for that $25,000, sign and drive right now. Would somebody say, no, 6 is higher than 4? I'm going to go back to my bank, take out the $25,000 and pay cash for that vehicle? Or are they going to say, yeah, I'll take that 6% because they understand how math works. And 4% uninterrupted compounding at $25,000 for 60 months is greater than if you were to pay a 6% loan for 60 months. The difference would be approximately $1,500 that you would make more by leaving your money in at 4% and paying the 6% loan, because a loan is a depreciating asset that the interest goes down on, and the 4% uninterrupted compounding interest is an increasing asset. So you make more money at 4% and paying 6%. But your brain thinks 6 is more than 4. Why would I want to do that? But that's not the way math works.
Yeah, it's pretty amazing. I mean, Robert made a good comment over here too. How much, he said, basically, you take a mortgage at 3%, and then compare that to a first lien HELOC at 7.5%. You put the same amount into both of those for the same amount of time, your principal is going to be a lot less. You're going to put a lot more towards principal with the 7.5% higher rate first lien HELOC than with that 3% mortgage, again, because of amortized versus simple and the way that the interest is paid on those. And so you would never think like, hey, let me trade my 3% mortgage for a 7.5% line of credit. But when you actually run the numbers and look at it, that's actually what happens. And that's one of the big tricks that the banks play and have really tricked people on over all these years.
And another thing I say to people, well, if you have $10,000 in your savings account, why don't you just take the $10,000 and put it down on the mortgage? Oh, you wouldn't want to do that because now you don't have control over that $10,000. But if you have a HELOC, you would want to take that $10,000, put it into the HELOC. Why? Because you can take it out the next day. You're in control.
Yeah, I mean, back to your picture. I mean, you show it right here. So again, he has all his W-2 income. So any money Joe's making from basically policies, any of this stuff just goes right into there. Owns a lot of rental properties. That income just goes right into there. Then all his monthly bills, all his daughters, travels, all the fun that Joe has, all the vacations and trips and Cadillacs and cars and everything, is coming right out of this HELOC, the payment. But then all that other, goes into the policies. All the policy money's going to investments, which we'll talk about different opportunities, investments in this part of this here in just a second and how you can do that. Because for a lot of people, Joe, they might be looking at this and like, oh, I don't have any rental income right now, or I might not have a policy so like, what is this going to do for me? So we got to kind of show, somebody that's starting brand new, like what's step 1, what's step 2, like how do they get to where you are with this right here? You know what I mean?
Well, that would be the 4 pillars. The first things first is you need to pay yourself first and be in control. Paying yourself first is creating the IBC and utilizing that as your banking system, as your foundation for banking. That's paying yourself first and being in control. Not only that, you're not in control with the mortgage, but you are in control with the HELOC. So flipping that over gets you to that step. And then once you get to that step, you're going to pay off your bills. You're going to debt consolidate. That's going to be living in the HELOC or be utilizing the IBC to get rid of that, whatever problem we're solving. And then money not in motion does not make money. Now we're going to go into the savings aspect inside the HELOC. Once we acquire enough of money for an opportunity that we know, like, and understand, and we want to invest in, now we can move that to start making the interest. You can't all do this at once. Some people can, some people can't. But I mean, I started this back in 2010. You know what I mean? I've been utilizing velocity banking and HELOCs, for 15 years. Yeah, I've paid off my house 4 different times within, that amount of time. But, this is a wealth. This is a long-term play. This isn't a get-rich-quick scheme. This is, a habit, a day after day. This is a lifetime of, utilizing.
Yeah, absolutely. I mean, Robert said he paid down $80,000 of principal in 1 year by leaving a 3.12% for a first lien 7.5%. Let that marinate. I love it, Robert. Brett said, Joe got this running for me after I got referred to Chris's team from Christy Van, which is really cool. Christy Van has got a great show on how velocity banking works. And Brian just put those 4 steps, 4 rules, 4 laws of doing this over in the chat box as well.
Yeah. And one thing too that it comes up a lot in the conversations, especially, Christy Van, clients, is the cash flow aspect of this. Because this is one thing that people get hung up on, Joe, and I want to make sure that we clarify it because it is very important. When you look at a mortgage, they're going to sell you on the interest rate and the payment. Low payment, low interest. That's what they're selling you. Keep in mind, that's a mindset issue. When they go look at a HELOC, the payment is different. It's a simple interest payment. So the payment is going to be higher than a mortgage payment. But that's where people stop right there and they get kind of stuck on that. But if you're doing velocity banking, because you're dumping all your income, let's say Joe, can correct me if I'm wrong here, but let's say you have
sometimes it might be higher. It depends on a couple of different aspects, and that's all math. How much the cash flow is coming in per month, how much is going out per month in your bills. So I mean, if we consolidate, we might save $3,500 of cash flow that's going out, and now you're in control again.
Correct. But the one thing too that they didn't believe me, but they went and did it, and then it came back and said, "Holy cow, you're right." Is that, let's say you have a $2,000 payment on your HELOC, but let's say your income is $10,000 per month, just using a round number here. What happens when you put that $10,000 income into the HELOC? What happens to the payment?
You just dropped your principal down. Now your interest is less,
and you satisfy the payment. And now you take money back out of the HELOC for your expenses, your cash flow really hasn't changed.
Mm-hmm.
That's a huge mindset shift for a lot of people because they're saying, well, wait a second, I'm paying more. You're not, because you're effectively reducing the rates and your cash flow is not changed. This person went from a $1,500 mortgage payment to, I think it was like $2,300 HELOC. They're like, oh, I'm going to be out of pocket more. I said, no, you won't be.
Real quick with that. Let's use your numbers. Somebody makes $10,000 a month that comes into the house. They have $5,000 in bills per month that goes out. That's $5,000 left in the HELOC. Did you ever put $5,000 down in 1 month on your principal of your mortgage? Never. You wouldn't want to do that. But using this tool, this system, you do it every single month that way.
Yeah. Now, to answer a question somebody asked, is there a risk with a HELOC? Yes, there are some risks, because I had a bank shut down one of my lines of credit one time, so there is that aspect of it. But you've got to use the right banks, though. That's one of the key things. If you're going to your local bank and big banks and they're giving you a HELOC, it's not the same thing as some of the banks that Joe uses. Is that correct?
Yeah, I have, since 2010, I have never had a freeze or anybody decrease my line of credit ever in 15 years with the HELOCs that I've used and the banks that I've used. So it's never happened.
Yeah, so using the right banks is pretty important, to be honest. Now, so I'm going to explain to you, well, there's a lot of questions coming in. So I'm going to really quickly explain to you how I'm going to be using a policy to do exactly what Joe just talked about. Because it is a bit different when you're using something like a infinite banking policy versus a HELOC, because I can't get a HELOC yet. I'm going to, hopefully in about next year I can do one. So I'm going to be opening up an infinite banking policy. I'm going to be doing a sizable, what we call a dump in. It's a big deposit upfront. I'm going to get access to around 95% of that within the first 30 days. Okay, so call it $40,000. I'm going to borrow from the policy. I'm going to knock off some high debt from a business that I closed. So it's going to go from 15 to 19% interest into a policy. It's going to be maybe 6%. Simple interest. Keep this in mind, simple interest. Okay, now what am I going to do? So because I control this, but here's the cool thing with infinite banking is I control all aspects of the situation. There's no bank involved. It's just me, the Bank of Brian. Okay, so what I'm going to be doing is all the income that comes in, I'll pay that down on that policy. So I'll put income into the policy loan to knock the balance down. Joe already talked about that, how that interest rate is calculated. Then I'm going to use a credit card and going to use that for all of my expenses, gas, clothing, food, whatever. Okay. And then at the end of every month, I'm going to borrow back out of the policy and pay off that credit card at 100% down to zero. So I'm going to go from a 19% credit card over here into a policy that's at maybe 6%. But because of doing velocity banking with that line of credit, which is my policy loan, it's probably going to be more like 3%. So I'm going to go from 19% to 3%. And then any extra money that I have cash just lying around, where am I going to put that money? I'm going to park it in my policy loan because it's liquid. I can get it back out whenever I want, but that means I'm not paying interest on that money that's sitting inside there. So really quickly, I'm going to go from high interest credit cards down to about 3% or even lower.
Even lower, I was thinking.
Yeah, probably going to be even lower, which is going to accelerate the amount of time that's going to take to pay off those debts. Probably cut it by not by 2/3 or more. So that's what I'm doing. And I'm going to be documenting how I do it because there is a couple different more steps you got to do versus a HELOC, because a HELOC will sometimes have a debit card tied to it. So you can just do it direct. I'm going to use a credit card, but here's what the credit card is going to do for me. It's going to be a cashback or miles reward card. So I had a client do this, Joe, that was doing this. This is a couple of years ago, and they were getting an additional $7,000 of cash back every year of income from the credit card because they were doing this something very similar. So I'm actually going to be going so if you can consider that and calculate that in there, I'm actually making money by doing this versus paying interest.
Correct.
That is a very different mindset right there. I'm making money, paying off my debt. It makes no sense, but it does.
But you're paying yourself first.
There you go. Number one. Yep. Pay yourself first. Be in control. So the one thing to keep in mind with the HELOC, the bank is making money off of you. With infinite banking doing the same thing, I'm making money. Now,
yeah, I'm totally fine with giving the bank their 8, their 6, their 10%, because I'm using that money and putting it into something that's making me more than that. That's arbitrage. I'm just using their money to make more money.
Yep.
And when it comes to taxes, I'm using interest.
Yep.
I'm not using my W-2. I'm going to pay my taxes with interest. So I really don't even care about that.
I love that part of it too. That's awesome. Yeah. So another thing that comes up, and obviously guys, a lot of questions, we'll probably stop here and just dive into a lot of the questions. So a lot of people are saying, how do you combine a HELOC and infinite banking? So that's the very common question. You got to understand that first. It doesn't always make sense for people, but Joe, you kind of wanted, and we kind of talked about it already a little bit.
A little bit. All right. So the HELOC would be the operating account. When you run the money through the policy, that's exactly what you do. You wouldn't want to keep cash value in the policy because the policy is an asset from day one. The HELOC is technically a liability until you take the money and put that into an opportunity to make you interest. So therefore, we can't do anything about that 8% interest that we're paying in the HELOC until after we put that into an opportunity. So if you're utilizing the IBC as a monthly or as a quarterly or annually, you would use the money out of the HELOC, run that through the policy, hit the cash value button, that money goes directly back to the HELOC. Now that's where we warehouse all of our wealth. Now after it goes into the HELOC, now we're going to put that into the checking account to put that into the opportunity. So I utilize my IBC and my HELOC as one. They're symbiotic. They're together. So I just run my money through the policy. Why? Because I know that in year 11, the money that's running through is going to be 200 to 250% cash on cash. I know that my policy now, after 4 years, I'm making cash on cash. I'm just running it through, and utilizing the money. Now, after, say we have a $500,000 HELOC and we owe $200,000 to our policy. So after these 3-4 years that I'm utilizing this money and putting it into the opportunity, I start off with 100. Now I move it up to 2. Well, now I'm up to 5. Now I'm up to 7. So now I have $700,000 out working for me, making money. When that opportunity comes back, can't I just fill up the HELOC, fill up the policy, and not have any debt? Absolutely. So when you're utilizing the money, while you're utilizing that to make more money by using leverage in arbitrage, the amount of money that you have out in positions, in opportunities, as soon as that number exceeds the number that you owe to the HELOC and the policy, you're just even and keep on making more money, because what happens? 700,000 at 12%, that money just comes back into the HELOC. And as soon as you get another 50 or 100, what are you going to do? Pillar 3, money not in motion does not make money. You're going to put that out. So now you have 750,000, 800,000, $1 million. That number just keeps on going up. And the amount of money that you're just running through, that's when you're spending interest and not principal.
Love it. So everybody wrote that down? All right. So I know we got quite a few questions coming in here. Wouldn't mind hitting some of these.
Yeah, definitely. I'm just going to start at the top here. So sorry, I first placed this in the chat. Do you help find investments that give more than the HELOC interest? So it's a good question. And what they mean by that is, some ways people utilize a HELOC, they'll tap into the equity in their home to generate income. And the way you do that is by making a spread. So we all use a platform called Private Money Club, which is a community that we founded, for this need, because we had so many clients that were starting banking policies, paying off debt a lot faster than expected, now have control of their wealth. And they're like, okay, well, now what do we do with all this cash value in these policies? And private money lending through real estate backed loans is a great way to do that. It's a great, safe, protected way if you do things the right way. It's backed by the real estate in a first position, just like we're talking about, just like the banks do. So we started Private Money Club. So very commonly on Private Money Club, you'll see deals offered at 12 to 15% annual interest with monthly interest payments. So what you would do in that case is, let's say you have $100,000, you're borrowing at 8% in a HELOC. Well, you lend that $100,000 out at, let's say, 15% on a private money deal, on a real estate deal. Now you're making the difference between 8 and 15, 7% returns on money that otherwise would just be stuck in your rafters. So it is a great way to do it. I mean, there's lots of other investments. I mean, our advice for investing is know it, like it, and understand it. So the Private Money Club has been a great solution for a lot of people, a lot of education provided, tools provided to make sure that you know, like, and understand it. So I would definitely check that out if you're needing help with that. Christian said, for a first-time home buyer, how do you get a HELOC to buy the home instead of getting the mortgage?
So you can purchase it with a HELOC, depending on the bank. We use First Lien, the First Savings Bank. 15% down, no PMI, 85% DTI on the house, that's income ratio, and 45% DTI up to 85% of the house, LTV, loan to value ratio. And you have to have a 700 for a credit score.
All right, cool. Shane said, how do you break down the funds to avoid co-mingling funds from an LLC to repay the HELOC, which is in your personal name?
So are you doing a capital contribution, or are you lending the money to the LLC and paying yourself back interest? If it's going to be an LLC, at the end of the year, you're still going to pay taxes on everything in that account. So you just need good paperwork to know where the money is flowing back and forth when you go across that little water. I call it the waterway.
Yeah. If you have a good CPA, they can help you with that as well. Just keep that in mind, because they got to do your taxes. But yeah, definitely have that paper trail.
All right. Steve said, I have been having a problem getting a HELOC because I own 40 acres of land. He's been rejected by several banks because of the land. Do you know any lenders that will do the HELOC amount of land. He's got 800 plus credit and good income, so easy qualification.
Yeah, ours goes up to 10 acres actually. The only thing that I can come up with that we actually came up with at the bank is to get that sectioned out. You would take the parcel out of your house and maybe just rezone it as one acre and then use the other, but we haven't come up with anything that can do 40 acres yet.
Yeah, I'm not familiar with anything else either. Brian, anything on that one?
No.
Is it possible to cash out an IRA and move the money directly into this type of account?
Yeah, yes, you can. It just keep in mind the implications of doing that and the penalties and the taxes. You cannot do a rollover direct from an IRA because that is a qualified retirement plan. You cannot roll it directly into infinite banking, but you can cash it out. Depends on age, all that kind of stuff.
Yeah, I mean, if you're under 59 and a half, you're going to pay some penalties. If you're over 59, if it's a traditional IRA, you're going to pay, taxes on that money coming out. So if you do it all at once, if it's a large amount, that could really bump up your tax bracket. So you're gonna have to do some strategy around that. We typically speaking recommend keeping it separate. So your IRA money, retirement money, 401k, all of those qualified funds, keep in qualified money unless we come up with a strategy of you to start bleeding it out annually, maybe roll it in some type of annuity as well, something like that. But commonly speaking, especially if you're younger, unless you're very young, then it might be worth paying those penalties, getting it out and getting control of it. But if you do need to keep it in there for whatever reason, we'd recommend a self-directed IRA, which just basically gives you control of those retirement dollars. So instead of having to invest in the stock market and funds and things like that, a self-directed IRA, there's no penalties, no tax implication, anything like that. You're just taking control of it through a self-directed custodian. And now you can do private money lending through Private Money Club. You can put it into IP, personal investments, businesses, precious metals. You can invest in almost everything with a self-directed. So, and then everything that goes through your infinite banking, the picture we just showed, all the equity, that's going to be non-qualified money. So typically speaking, keep it separate, but there are strategies depending on your age and situation that we could help kind of show you. Is that fair to say, you guys?
Yeah.
John said, what is a good whole life policy insurance company that knows how to set up the IBC? Is Lafayette a good one?
So it's not the insurance company, it's the agent that sets it up. So that's something to keep in mind. So yes, Lafayette is a good company, One America, Security Mutual, New York, those are all kind of some of the top companies that we use. But once again, if you go to the Lafayette and say, set me up with an infinite banking, that's like playing Russian roulette right there, to be honest, because whomever you're talking to is also an agent, but they're trained in more traditional insurance, not always infinite banking. We focus on infinite banking. So it doesn't matter if they set it up for you, if they know how, or we did it, it'd be the exact same policy. So that's why we always recommend going with somebody who is certified in infinite banking so they can set it up correctly.
Yeah, and it goes along with another question that popped up. You mentioned how you get compensated. I could call the insurance company. It's the same policy. Can you explain why I'd want to take that call with you and not their 800 number? And Brian, that's a big part of it. I would also say that, and this is what we do, guys, just to clarify, like myself, Joe, Brian, we are licensed life insurance agents. And so Lafayette's a great company. We do a lot of business with Lafayette. They have incredible banking policies, but we also have the ability to take you with other carriers also. So we work with a half a dozen different insurance carriers. Lafayette's one of them, One America, Guardian, SML, just to name a few. And so what we do is we look at your overall picture. What are your goals? What are your money problems? What are we trying to solve? How much are you putting into premium deposits? All of that. And then we say, okay, let's run the numbers with a couple different companies. And we actually will look behind the scenes and figure out what company is best for your situation. So, one person might make more sense to go with One America. One person might make more sense to go with Lafayette. So we also have the ability to work with multiple carriers depending on your situation. And then as you start to add additional policies, maybe you want to start putting it with different companies that way as well. And so we have the ability to do all of that. And this is all we do all day, every day. So Brian and Joe can put their numbers over there. I'll put their calendars in the chat one more time. Just click on the calendar, pick a day and time, schedule a call with or get on a Zoom, a video call, and you guys can talk through this stuff, what it looks like. I'll also put the full 90-minute video on there that I would recommend watching before you get on that phone call, just to open up your mind a little bit more and write down a bunch of questions. So when you guys connect on that call, it's a really good conversation. So I'll add that over there as well. But that was a really good question. I like that one. All right, Deborah said, I'm 65, have a small IBC policy and no debt mortgage. Now what?
Depends on your goals. And that honestly just depends on the goals. What are you trying to accomplish beyond that? So, I mean, awesome. If you're, when you're in a place of no debt, that's amazing, because now we start to look to put that to work for us. That's the way I look at it, is now putting that money to work. But once again, it does depend on what your goals are and what you want to accomplish. But that's what we can help you with.
What problem are we solving?
Yep.
Yeah, that's right. I mean, you know, if you're up to it, I would say start moving that money and putting it into some conservative type places where you can generate some monthly income and cash flow for yourself. Why not, right? All right, Kat, I used my HELOC to start a whole life policy, then my whole life policy to pay off a car and pay down the balance of the HELOC. I don't understand if I'm supposed to continue to pay the HELOC and or start paying back the loan on the whole life. I'm not at a point where I'm ready to start using it for investing lending, but hopefully next year.
Let's have a strategy call.
Yeah, that's a strategy call out there. But I mean, if I was in that situation, I mean, you'd be doing velocity banking with the HELOC.
Yep.
The payments, the debts that you paid off, that's freed up cash flow, goes into the HELOC, back
Yep.
out policy loan. That's
Correct.
the simplest explanation right there.
All right, cool. That was the questions.
Yeah.
So
There's a lot in the chat box.
I know. If you guys can put the questions over in the Q&A, unless you see one, Brian, go ahead. It's just hard
Yeah.
to keep up with them.
Yeah, Karen said, what is the smallest amount one can buy an infinite banking policy for? So one, you're not buying a policy, you're funding a policy. That's why we call it a premium deposit. But minimum 10 times your age per month. That's pretty simple right there.
And I say it depends. If you're paying $300 to a credit card bill and $300 to a car loan, why would you not want to pay yourself first before paying those bills?
Yep.
So there's a maximum of 25% of your annual income per the IRS guidelines. So depending on what problem are we solving, how much money do we make, how much money do we want to pay ourselves, and how much money are we utilizing to pay debt, that's where it comes down to. It's all math and numbers.
Yep. Someone said, can I do a HELOC for my free and clear house and use it for life insurance with infinite banking? Yes, that's kind of what we explained, where you put up the HELOC to then fund the policy, then take the policy into an asset, velocity banking on the HELOC, and there's your full circle right there. Whatever cash flow you do with the policy loan goes to the HELOC, back into the policy loan. There's your full circle right there.
Correct.
See, the first lien HELOC replaces a mortgage if you have one. And then, Sean, I'm not sure about your comment. Why would anyone accept a loan at 15%? Depends.
I'll do it all day long.
Yeah. Depends if you're lending or borrowing. I borrowed at 25% and it made a lot of sense. Cash on cash return was amazing. So it just kind of depends on the situation, of course. I'm not sure what you're asking there, though.
Well, investors. So to clarify, a real estate flipper, you know, let's say they're going to buy a home at $100,000. They need to put $50,000 into it, and they'll sell it for $250,000. Well, where are they going to get that $150,000 to buy the property, put the rehab into it so they can flip it and sell it and make money? Well, some flippers are able to go to the bank and get traditional money from the bank for an investment property. But what are the challenges with that? You're dealing with a bank. So you're jumping through a million hoops. It takes forever to qualify, to deal with the banks, to get the money. There's a lot of fees involved. There's a lot of, you know, a little points involved, things like that with that mortgage. There's a lot of complexity to working with banks. So, and on top of that, you know, if you're trying to do more than one deal at a time, most banks are going to limit you to your debt to income ratios and everything else. Banks, you fit within a very small little square strict. And if you fall anywhere outside of their lending parameters, you're not getting that loan. So for most investors, they prefer to deal with private money. So what we can do as private money lenders is I can say, hey, listen, yeah, I know you don't want to deal with the banks. I know you're going to get this deal. You're going to make $100,000 on it. Well, you know, over the next 3, 4, 5, 6 months, while you're doing the rehab before you sell this thing, I'll lend you the $150,000, pay me 15%. I guarantee you go interview 100 real estate investors today, 99, if not all 100 of those investors would be more than happy to pay 15% to a private money lender than deal with a bank at 8%. I can promise you that. I guarantee it. So there, and I talk to investors every single day. So that's why an investor would pay me 15% of my money as opposed to just going to a bank, simply put. Does that make sense?
Another question came in here. Well, some more came in. If my trust owns my primary home, can I still get a first lien or second lien HELOC?
Is it an irrevocable trust, a revocable trust? Who is the beneficiary? How long has it been in there? Different questions.
Yeah, so it depends. Can you get a HELOC at any time? Can you get a HELOC with a part-time job or full-time? I mean, those are all, I mean,
Depends on income. You have to still qualify.
Yeah, it's all qualification. All
yeah, you gotta qualify. I mean, yeah, part-time job making $100,000 a year, sure. Yeah, depends on the house, the value, the HELOC. There's lots of factors involved in that.
Exactly.
Yeah.
Let me hit this one from Allison O'Fesh. There's a Guardian whole life policy with 25,000 available to borrow. That's awesome. First off, Allison, congratulations. Do you recommend taking the loan to invest in a REIT? You're thinking the right way. You know, we do take loans to then put our money into real estate deals, private lending, real estate backed deals. I would personally never invest into a REIT. So a REIT's a real estate investment trust, which is basically a commercial private fund, publicly traded private fund is all it is. But typically they have higher fees, higher administrative costs, all that stuff, because it's part of a big conglomerate. It's something that I used to offer at Ameriprise Financial before I learned what the wealthy do, which is control their money and do direct lending, private funds, private lending, things of that nature. So you're going down the right path. As an alternative, Allison, if you're new to this, go check out Private Money Club. You'll start to learn all about it. So privatemoneyclub.com. And I think that would probably be a better route for you.
Yeah.
And I'll answer Corey's question. Yes, because it's revocable.
There you go. Someone said, do you write with Forrester? That's an insurance company. The answer is no, we don't. I've had clients that have tried to do policies there and they've had a lot of problems and they don't seem to be very infinite banking friendly from what I've heard. But no, we don't need to, by the way. So we've got great companies that really support infinite banking. Let's see here. I'll be 59 in August. Would it be better off to wait until 59 and a half to take out the IRA and pay taxes, or take it out now, pay the penalty?
Wait.
Not financial advice, but you know, it depends on the amount of it, depends on what you're going to do with it, depends on the return you're going to get. I mean, in most cases, probably not. I wouldn't think, but once again, I'm not going to provide financial advice on that.
Yeah, no financial advice. Probably wait, but more importantly, if it's in the market though, maybe move it into cash or get it out of there, or move it into a self-directed and put it something you can control. Markets are down on the year, probably going to keep dropping. So just be wary of that. You don't want to, be waiting, but riding the markets and losing money the whole way down either. So,
and I wouldn't want to pay the extra 10%.
No, yeah, that's what I'm saying. Probably wait or self-directed, take control of it or just move it to cash.
So Linda's asking about a recording of this. How do they access recording?
So go to YouTube channel. It's YouTube at the Chris Naugle. Just subscribe to the channel. The YouTube for this wealth webinar will be posted on Saturday.
Yep. There you go, Linda. Do you continue to advise over the years?
I have clients that call me every month because they're a flipper and they're utilizing the HELOC and another business line of credit and they're closing on this house. So yes.
Someone said here, anonymous said, I have an opportunity to get a second lien HELOC at 13.75%. First off, that's pretty high right now. That's a very high one. But happen to have a calculator or Excel sheet to help figure out the comparison. Comparison to what? So if you want to do like financial calculations, I recommend a website called dinkytown.net. You can just Google it. Great website for financial calculators.
Another thing too, that if I pre-qualify you, we run through the numbers, and then we have a call with the bank, I actually do the Zoom call with you. You don't do anything by yourself. I hold your hand through this whole entire process. I hold it through the HELOC, through the IBC, through the strategy sessions. And as long as there's a spot on my calendar, you get an hour strategy call every month, every quarter, whenever you want.
Yeah. Kurt says, what's the oldest person can do to get a whole life? 74, I believe, as it is. I think 74 years old. That's the oldest I've ever done. Beyond that, it doesn't typically work. But keep in mind, you can always get policies on somebody else, somebody who you have insurable interest on, spouse, adult kids, etc. So I have a lot of people that are doing that. So, are you free today, Joe? That's funny.
You see the HELOC at 13.75? That's the highest I've seen, I think.
Yeah, I was gonna say that's pretty high. So, I mean, if you can get a HELOC at that, you can probably get one at a lower rate with a more friendly banking institution.
Yeah, no, give me a call because I mean we're running at 7 7.9 right now.
Yeah.
And we operate in 45 of the 50 states. So if not, I hold your hand. You're going to go to a couple credit unions. You're going to come back to me with the paperwork. I'm going to see which one is going to be the best for us to utilize what we need to do. You're not going to do anything by yourself. I hold your hand through everything.
It's not Dinky, it's Dinky, like small. I don't know why it's a weird name, but I've been using them for over a decade. They're great website.
Some of the best websites always have the oddest names, don't you
Yeah.
notice that?
Yeah, they have hundreds of them. This is great. And you can print out reports and things. I've used it for investment properties, all sorts of stuff. All right. So someone said, I'm 44, have 30K left in a 401k, and was about to start an IBC policy taken from the 401k, but I'm hesitant and was wondering if I should take a HELOC instead to start paying off debt and then open up a HELOC. I think you mean then open up IBC. I have no more savings besides the 401k. So to be honest, there's a lot going on there. We'd have to sort of unpack that. Yeah, we'd have to unpack that situation, see what makes the most sense for you. Just from that little bit there, I couldn't really say one way or the other. Depends on if the 401k is with your current employer, those kind of things. But that's why I recommend scheduling a call with one on our team, so we can help you with that. And Deborah, there is no cost for us to work with you. Keep that in mind. So Stephen kind of went through how we're compensated, but it's through the insurance companies. But yeah, there's no fee or cost to work with us on this stuff.
Can you throw our links in again, Stephen?
Yeah, I'll put it up right now. Oh yeah, let me post a 90-minute video too. Let me grab that while you guys are two more questions.
So it's a great question here. This is a good one. So velocity banking is the precursor to infinite banking if I'm currently in debt and don't own a house. Some money in precious metals, self-directed though. To be honest, I mean,
No.
it depends. It depends. Yeah. You have to look at your situation. It's not going to be the same for everybody. Depends on your resources, depends on what you have available. It just depends, to be honest. But I personally am doing infinite banking before velocity banking. I'm doing infinite banking to do velocity banking.
Yeah, you can do IBC, and by doing the IBC, we can get you to the level that you can do the HELOC, and we're going to utilize it that way. So it just depends on what stage of the game you're at. That's a strategy call.
Yeah. Yeah, I think we already answered that one.
Yeah, the velocity banking, you see that?
Yeah, the precursor one. Yeah, I saw that one. That's what I was referring to.
Yeah, okay.
Can you do Joe, do you assist with whole life policies for a child that is 4 years
Yes.
old? Yeah, I mean, that's called, juvenile policies.
I started my daughter off at 10 years old with
Yeah.
her policy.
Now, typically we would start with you first if you're insurable, because you want to insure the kind of the head of the families, and the patriarchs, the income earners, and then you work your way down through the family. Just from an insurance perspective, that makes sense because you want to insure against, loss of income. That's bottom line what's going on with insurance. But but right now I've got a grandparent that is opening up a policy on their grandson. And I've done that many times. So it's called a grandparent policy. It's actually what they call them in Lafayette. I think it's kind of funny. So, you have a policy? Yeah. By all means, Marcia. Yeah.
I'm just putting some links over in the chat box for everybody.
So Kat, if you have a money mentor, I mean, you can always reach out to them for a strategy call. The implementation team. So by the way, for everybody who's listening, so we do have a full team that supports you with infinite banking on an ongoing basis at no cost to you. So if you have questions, technical questions, hey, I'm going to go do this, going to borrow, how do I structure the loan? We help you with that stuff on an ongoing basis. And then I have lots of existing clients, like Joe said, that are calling me and said, hey, I've got a thing I'm going to do over here. Does this make sense? And we're going to talk about it. Or they said, hey, I need to change, something in my policy. They'll call the implementation person. So Kat, it just depends. If it's more of a technical question, your implementation team is going to be the best. But if it's more like a strategy question, that should be your money mentor.
Yep.
And then MJ Rodriguez said, do you have to qualify medically for a whole life policy with a medical exam? In most cases, yes. It depends on age and the amount you're asking for, and then your medical history. So sometimes no, sometimes yes. But in most cases, I just say yes to be safe. But if you're 25 years old and have never been to the doctor or had surgery or in great health, probably not. Just depends. But
Cool.
All right. That a wrap?
Yeah, we'll go around the horn. Any last minute words from Joe and Brian, and we'll get this thing wrapped up.
Nope. I look forward to everybody reaching out and strategy calls to see if you can qualify, or let's see what we can do to fix your problems and take you to the next step.
Yeah. And just one last thing I'll mention to everybody is that, if it doesn't make sense, stick around, keep learning, keep listening, because like Joe, he had his moment. I had mine. We all had that at some point on our journey. And when that happens, it's amazing. It's glorious. It'll change your life. So just kind of stick around. And when it makes sense, it'll make sense. Yeah.
Yeah, that's so very true. So I'm just sharing one more time. There's a 90-minute full IBC training video if you want to check that out. Then schedule a call with Joseph or Brian. If you want to watch this replay as well as all of our other daily content over at YouTube, just join the channel at the Chris Naugle. If you subscribe, it'll alert you, and you can easily navigate on YouTube back to the channel whenever we put new content up. And finally, we do 5 other live free webinars every single week where we talk about financial education, real estate investing, what's going on with the markets, becoming your own banker, and of course, infinite banking. So I'll put the link for those. You can join us and register for those weekly shows. If anybody needs anything from myself on self-directed IRAs or anything else, shoot me an email, snaggy@privatemoneyclub.com. or whatever email you have for me. All that being said, appreciate everybody being here today. This was a lot of fun. I know Chris has some other travel coming up over the next couple months, so you might have us back. I know Chris usually hosts this show, but I appreciate all of you being here, listening to Joe, myself, and Brian. I don't know about you guys, but this was a lot of fun today. It went by fast too, right? Went by quick.
Oh, yeah.
Very good stuff. All right. Well, we'll see you guys next week for Wealth Webinar, and I hope you have a great week. Thank you. Bye-bye.
Bye-bye.
All right, so I hope you guys enjoyed that episode. We're putting up tons of them, but I think if you like this one, you'll probably like that video as well. Not only that, I've got a book that I created, Mapping Out the Millionaire Mystery, where we actually show you what the wealthy do in the game they play with money. I want you to have that for free. And if you want to know about all my new videos coming up, click that alert button. Actually, smash that alert button, and you'll be notified every time we put a new video. So we'll see you on the next episode.